Yes, sir, your YouTube live, sir.
Yeah, we can start now.
Yes, sir, we can start, sir. We can start.
Okay. Yeah, good morning, students. Student comment section on our platform so that they can ask any doubts. Live chats will be there. Yeah, Rahul, good morning. Yes. Say happy Tamil New Year. Shall we start our session? So thank you for SICASA for organizing this program. Welcome to SIRC of ICAI. From today, coming 4 days, we are going to conduct costing revision class, Fastrack revision for coming May examination in your scheme. Yeah, Joy, good morning, Kumar. Any preference of topic you need to start first? If you have any preference, you can tell. Otherwise, I can start my session. Any preference from your end? Then we can start with your favorite topic, standard costing. With respect to standard costing, guaranteed one question for each and every attempt. It's both applicable for inter as well as final. 2-in-1 topic, standard costing. Now, what do you mean by standard? Standard is nothing but expectation. The expectation is called standard. Now, will the expectation and the actual will go together or not? Expectation and the actual will go together or not? Especially our own CA students' life. Will the expectation and the actual will go together? Not always go together, right? So the expectation and the actual is not going together. Then we are going to have the difference. The difference is called here variance. The difference is known as variance. So standard is nothing but one expectation. Since expectation and the actual may not going together or not going together, some difference will be there. The difference is called here variance. Our object, we have to identify why the variance has occurred. What could be the reason for the variance? The reasoning for the variance is called variance analysis. So, in this topic, expectation. In this topic, we are going to discuss about variance analysis. That's the topic name is also called variance analysis. Now, with respect to variance analysis, where and all variance may occur, where and all variance will come. Now, with respect to variance, engangala variance or a chance. Where and all expectations are there and all variance will come. Where and all expectations are there and all variance will be. So, where and all expectations will be there. எங்கெல்லாம் expectation இருக்க chance இருக்கு? With respect to variance analysis. Where and all cash flows are there and all expectation will be there. So, where and all cash flows are there and all expectation will be there. Understood? Where and all cash flows will be there. Cash flows are broadly classified into two. One is income side, another one is expenditure side. Income and expenditure. So, with respect to income side, we may have one variance called sales variance. So, why the variance happen? Sales, expected sales will be different, actual sales will be different. So, the difference may happen. Why there is a difference? That analysis is called variance analysis. That is called sales variance. Similarly, expenditure side, where and all variance will be there. With respect to expenditure, we may have material, we may have labor, we may have variable overhead, and we may have one fixed overhead. So, expenditure side, material, labor, variable overhead, and fixed overhead. So, income side one variance and expenditure side 4 variants. Totally 5 variants. For intermediate concern, income side variance not applicable. Only we are having expenditure side variance on inverse surplus. So, expense side, what and all will be there? Material, labor, variable overhead, fixed overhead. So, we have discussed about the 5 different variances: material, labor, variable overhead, and fixed overhead. Now, we are going to discuss about the variance analysis. First, we can consider the material variance. The expected material cost will be different. How much the actual cost incurred by the company will be different. So, why there is a difference that we have to analyze? That is called differential analysis. That is called variance analysis. From company's point of view, management's point of view, we have expected 5 lakhs rupees for material. Cost how much? 5 lakhs. When the expectation will happen? The beginning of the year. Understood? So, beginning of the year, for easy understanding, we can take the calendar year. 1st January, we have expected 5 lakhs for material cost. Total expenses to be incurred for the material. End of the year only, we can identify how much the actual cost incurred. Correct? So, the end of the period, nothing but 31st December, we have identified total material cost incurred comes to, okay, 6 lakhs. Total cost incurred comes to how much? 6 lakhs. Then, there is a difference between material cost expectation, and actual cost incurred. Alright? In this circumstance, we have to identify why the difference. Or, person in charge is responsible to give the management. We have incurred 5 lakhs, we expected to incur 5 lakhs, but actually incurred 6 lakhs. 1 lakh rupee expenses incurred more, excess expenditure. That 1 lakh, what was the reason for incurring additional 1 lakh rupee? That detail they are supposed to give to the management. Then you may going to give the additional 1 lakh has been incurred because of beginning of the period only expectation happened. Clear? That time material price in the market comes to assume 5 rupees. But actually during the period, price has increased to 5 rupees 50 paise. Because of increase, price variance has happened, difference has happened. So I'm going to calculate number of quantity, how much the quantity, and how much the price is different 50 paise. After identifying the same, it comes to total 60,000. Okay, out of 1 lakh difference, you have given reason for 60,000. Remaining 40,000 rupees, what happened? Remaining 40,000 rupees, again we got to analyze. After identifying the same, to produce a product, we have expected 2 kgs of raw material. To produce one product, we have expected 2 kg of raw material. But during the period, because of the poor quality of raw material, company has incurred 2.25 kg. Because of excess quarter kg, company has incurred another variance called 40,000 rupees. The 40,000 is because of usage variance. So we have given the justification. 60,000 because of what? 60,000 because of what? Material price variance. And the 40,000 is because of what? Material usage variance. Understood logic or not? So totally 1 lakh. So we have to give the difference, nothing but difference between expectation and actual. We have to give the explanation that is called variance analysis. Clear? So the entire topic we are going to discuss about what would the reason behind incurring the variance. Now, I'll share the question. Sharing option is not there. We are unable to share the question. Okay. Should I post the question in the chat box? That is possible. That's also not going. Question shared in the chat box itself. Full question is visible. Kindly check it. labor to labor only comes, right? Labor costs. Yes. I'll read the question. Z Limited has a standard costing system for its single output. The standard cost for 100 units produced are as follows. Material 100 kgs at rupees 10,000. Labor 40 hours at the rate of 20 rupees per hour, 800 rupees. Variable overhead 10 rupees per standard direct labor hour, 400 rupees. Fixed overhead is rupees 5 per standard direct labor hours, 200 rupees. Total 2,400. The following operating data will be taken for the May 2011. 500 units were manufactured. Normal volume is 220 labor hours, direct labor hours. 520 kgs of material at the rate of 11 were consumed. 120 labor hours at the rate of 19 rupees were used. Actual variable overhead rupees 1,150. Actual variable overhead is 2,090. Actual fixed overhead is rupees 1,150. You are required to calculate difference cost variance. Nothing but one. We have to compute all the variance here. So whenever you come across variance analysis, you have to follow the rule. Two rules are one is two rules you have to remember. One is identification of variance and draw the respective chart. Rule number two, filling the blanks. The two rules you have to remember. Identification of variance and draw the respective chart. என்னென்ன variance what all the variance available in this question? Material is there, labor is there, variable overhead is there, fixed overhead is also there, and sales also there. Therefore, we have to identify all the variances. So, sales variance not applicable. So, other than that, all expenditure variance you have to compute. Material, labor, variable overhead, and fixed overhead variance you have to compute. Now, with respect to material variance, being unable to write also it seems. Writing options also not available. Okay, I'll dictate no other go. So with respect to material cost variance can be classified into two types: material price and material usage variance. Usage variance again classified into material mix variance and material yield variance. So I'll repeat once again: material cost variance, price and usage, mix and yield variance. Mix and yield variance arises only if there is more than one quantity of material. If there is a more than one quantity of material, mix variance and the yield variance comes into picture. Here, only one material is available. There is no more than one cadre of material. Therefore, mix and yield variance not applicable for this question. So, total variance is equal to what? Material cost variance, price and usage variance. Formula with respect to material variance are 1 minus 2, 1 minus 3, 3 minus 2. So, 1 represents standard quantity into standard price, 2 represent actual quantity into actual price, 3 represent actual quantity into standard price. So, standard quantity into standard price, actual quantity into actual price, actual quantity into standard price. Our duty, we have to fill in the blanks. The first one is 90% problem. Second column information will be there in the question itself. What is called the second column? Actual quantity into actual price. Information with respect to actual quantity into actual price will be there in the question itself. So, actual quantity into actual price represent actual material cost incurred. That is given in this question itself. What about the actual material cost incurred? 520 kgs. The following data were taken from May 2011. Nothing but what? It's an actual information. 520 kgs is the actual consumption at the rate of 11. So 520 into 11 is equal to actual quantity of raw material consumed. So second column information is what? 520 into 11 is equal to 5,720. It's the actual raw material consumption. Are you clear with respect to actual raw material consumption? Okay. Then, whereas next column, actual quantity we can refill 520. Standard price per kg of raw material that is given in this question, the very first line. Material 100 kgs to produce 100 units at the rate of 10. Therefore, 10 rupees is standard price per kg of raw material. Therefore, 520 into 10 is equal to actual quantity into standard price. And first column is pending standard quantity into standard price. Standard price we got is 10. Standard quantity how to identify? Always remember standard quantity represent expected quantity of raw material. Expected quantity of raw material required for actual production. Expected quantity of raw material required for actual production is called standard quantity. The word standard always ends with the word standard, always ends with the actual production only. Therefore, to produce one product, we need 1 kg of raw material. How come 1 kg? It's given in the first line of the question itself. 100 kgs of raw material we need to produce 100 units of the finished goods. Therefore, to produce one product, we need how many kgs of raw material? 1 unit. Now, how many units they produce? Because the word standard always ends with the actual production. 500 quantity they produce. So 500 into 1 is equal to, because to produce 1 unit finished goods, we need 1 kg of raw material. 500 quantity we have produced. Therefore, 500 units of finished goods into 1 is equal to what? Expected quantity of raw material, nothing but standard quantity. So the first column, 500 into 1 is the standard quantity. Therefore, I'll repeat once again. 1 represents standard quantity into standard price. 2 represent actual quantity into actual price. 3 represent actual quantity into standard price. So 500 into 1 is the standard quantity into 10 rupees the standard price per kg is equal to 5,000. 2 actual quantity 520 into 11 is the actual price. Therefore 520 into 11 is equal to 5,720 is the second column, actual material cost incurred. whereas third 520 into 10 is equal to 5200 is the actual quantity into standard price. Therefore, material cost variance is equal to 720 adverse, price variance is equal to 520 adverse, whereas usage variance is equal to 200 adverse. Very clear? If you have any doubt, you can be the put in the text in the chat box itself. Any doubt, Kana? If you chat something, it will be more interactive. Okay. Next. I hope you understood. Material variance over. Now we can go for labor variance. Now, labor cost variance can be classified into two types. One is labor rate variance, another one is labor efficiency variance. Efficiency further classified into labor mix variance and labor revise sub efficiency variance. So the mix and the revise sub efficiency is applicable only in case of more than one cadre of labor. There is only one labor, it's not available. Therefore, only in case of more than one cadre of labor. Here, only one labor only available. More than one cadre means what? Skilled, unskilled, semi-skilled, like that. This means more than one cadre. Here, there is no subclassification. Therefore, only one labor. Therefore, there is no further classification of total variance itself. Labor cost variance can be classified into labor rate and labor efficiency variance. Formula 1 minus 2, 1 minus 3, 3 minus 2. That's all. 1, 2, 3 represent what? Standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. 1 represents standard hours into standard rate, 2 represent actual hours into actual rate, 3 represent actual hours into standard rate. Always I told, second column information will be there at the question itself. What is second column? Actual info. How much the actual cost incurred? With respect to actual info, actual labor cost incurred, which is given in this question itself. Okay, how much the actual cost incurred? How much the actual cost incurred? Actual number of hours worked 190 and rate per hour 19. Therefore, 190 into 19 is equal to actual labor cost incurred. Am I right or not? Clear? So, second column information 190 into 19. Whereas third column 190 is actual hours. Whereas standard rate we need. What about the standard rate? To produce one product, how much the labor cost? To produce per hour we have to spend 20 rupees. 40 hours they worked. Therefore, to produce the product, we have to incur 800. We need a labor rate per hour. Per hour rate given in this question itself 20. Therefore, 190 into 20 is equal to actual hours into standard rate. Whereas first column standard hours into standard rate. The word standard always ends with actual production. How many units? Actual production 500. To produce one product, how many hours you need? To produce 100 units, we need 40 hours. That is what given in this question. Therefore, to produce one unit, you need 0.4 hours. So 0.4 hours into 500 is equal to standard hours. So I'll repeat, 0.4 hours into 500 is the standard hours. Into 20 is equal to 4,000 is the expected labor cost. Whereas actual cost incurred comes to 190 into 19. Whereas last column, actual hours into standard rate, 190 into 20 is equal to 3,800. Therefore, labor variance. How to compute labor variance? Labor cost variance is equal to standard hours into standard rate minus actual hours into actual rate, nothing but 1 minus 2 is equal to 390 favorable. Labor rate variance is equal to 190 favorable. Labor efficiency variance is equal to 200 favorable. Are you comfortable? This is with respect to labor variance. So in examination, you have to specify whether favorable or adverse, that you have to specify properly. Clear? Good. Now, Any doubt with respect to labor? Next, material over, labor over. Now we can go for variable overhead variance. Now, variable overhead cost variance can be classified into two types. One is expenditure variance, another one is efficiency variance. E and E, expenditure and efficiency variance. Okay, expenditure variance and efficiency variance. Now, there is no subclassification for variable overhead variance. Total variance itself this much only. Clear? Now, with respect to variable overhead formula, 1, 2, 3 represent standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. Now, with respect to actual hours, say 190 hours. What about the standard rate? What about the actual rate for labor? 19 is the actual rate. Am I right? At the rate of 19, 19. Actual, yeah. No, variable overhead given in this question itself. Am I right or not? Yeah, 290, 2090, 2090. Yes. Actual variable overhead given in this question 2090. Actual number of hours given in this question 190. Therefore, 2019 is the actual variable overhead divided by 190 is equal to 11 rupees is for one actual rate per variable overhead. Same way, third column actual hours 1000. Actual hours is how much? 190, whereas standard rate comes to 10 rupees per hour. Am I right? Because standard rate, which is given in the question, variable overhead at the rate of 10 rupees per standard labor hour. So 10 rupees. So 190 into 10 is equal to 1900 is the actual hours into standard rate. Whereas first column, standard hours into standard rate. Standard rate is given in this question 10. Standard hours represent expected hours required for actual production. So actual production 500 units. To produce one product, you need 0.4 hours. So 500 into 0.4 is equal to standard hours. Comes to 2000. So variable overhead variance is equal to 1 minus 2. That is standard hours into standard rate minus actual hours into actual rate. 2000 minus 2090 is equal to 90 adverse. Am I right? So 90 adverse. Whereas the expenditure variance comes to 190 adverse and efficiency variance is equal to 100. Am I right? 1 minus 3 is the efficiency variance. 1 minus 3, 2000 minus 1900. Clear? Therefore, 100 favorable. Clear? So, variable overhead cost variance 90 adverse, expenditure variance 190 adverse, efficiency 100 favorable. Hope it is correct. Okay. So, any doubt with respect to variable overhead variance? So, material over, labor over, variable overhead also over. Now we have to go for fixed overhead variance. Shall I go for fixed overhead variance? Are you comfortable? Any doubt up to this stage? Yes. Now, with respect to fixed overhead variance, fixed overhead cost variance can be classified into two types: expenditure variance and volume variance. Volume variance again classified into capacity, efficiency, and calendar variance. Capacity, efficiency, and calendar variance. Now, when calendar variance arises, you have to identify. Whenever number of days available in this question, budgeted days and actual days information available in this question, then calendar variance arises. If number of days not given, then we have to solve the problem only by way of without calendar variance. Understand? Therefore, in this question, number of days not given in this question. Budgeted number of days and actual number of days. Therefore, this problem is based on without calendar variance. In case of without calendar variance, what are all applicable? Fixed overhead cost variance can be calculated into two types: fixed overhead expenditure variance and volume variance. Volume variance again classified into capacity and efficiency variance. Formula 1 minus 2, 1 minus 3, 1 minus 4, 4 minus 3, 3 minus 2. Clear? Now 1, 2, 3, 4 represent what? 1 represent actual output into standard rate, actual fixed overhead, budgeted fixed overhead, actual horse into standard rate. Here the specialty is, first one is actual output into standard rate represent standard rate per unit. Whereas in last column, actual horse into standard rate represent rate per hour, because you are multiplying with the hour. So I'll repeat once again: actual output into standard rate per unit, actual fixed overhead, budgeted fixed overhead, actual horse into standard rate. Now, actual fixed overhead which is given in this question, how much? 1150 is the actual fixed overhead. Budgeted fixed overhead, how to identify the budgeted fixed overhead? With respect to budgeted fixed overhead, rate per fixed overhead per hour rate is 5 rupees. Am I right? With respect to budgeted hours, you have to identify. So, what about the budgeted hours? Any info with respect to budgeted hours? Yes, 220 we have take. Clear? So, budgeted fixed overhead into budgeted rate R into rate is equal to comes to how much? 1100 is the budgeted fixed overhead cost. Clear? Whereas actual hours into standard rate, actual are available in this question 190 into standard rate comes to 5 rupees. Am I right? Because the rate per hour. So 190 into 5 is equal to, clear, 950 is the answer for the fourth column. Clear? Whereas first one, actual output into standard rate. What about the actual output? 500 is the actual output, and the standard rate is how much? Rate per unit. Am I right? Not rate per hour. With respect to rate per unit, fixed overhead rate per unit is total fixed overhead for 100 units is equal to 2000. Therefore, per unit comes to 2. So 200 divided by 100 is equal to 2000 again, 200. Okay, 100 units is rupees 200. Therefore, per unit cost comes to 200 divided by 100 is equal to 2 is the standard rate per unit. So 500 into 2 is equal to total fixed overhead with respect to what? Expectation. So actual output into standard rate is 1000. Actual fixed overhead 1150. Budgeted fixed overhead 1100. Whereas actual hours into standard rate is 950. Clear? Any difficulty? Therefore, fixed overhead cost variance comes to 1050. Expenditure variance 50 adverse. Volume variance 100 favorable. Capacity variance 150 adverse. Efficiency 50 favorable. Kindly check it up the total. I'll repeat. Fixed overhead cost variance 150 adverse. Expenditure 50 adverse. Volume 100 favorable. Capacity 150 adverse. And efficiency 500 favorable. Understood? Any doubt with respect to this? Good. Next. Similarly, the next question we can go. See the question in chat box. Hope you got the question. Yes. I'll read the question. Kiran got the question. TQM Limited has furnished the following information for the month ending 30th June 2007. Particulars, master budget, actual and variance available. Underneath, unit produced and sold under master budget 80,000 quantity, whereas actual 72,000 units. Sales 3,20,000 under master budget, whereas actual 2,80,000, variance 40,000 adverse. Direct material cost 80,000 in master budget, 73,600 in the actual, variance comes to 6,400 favorable. Direct wages 1,20,000 in master budget, whereas actual 1,04,800, variance comes to 15,200 favorable. Variable overhead variance 40,000 on the master budget, 37,600 in actual, variance comes to 2,400 favorable. Fixed overhead variance master budget 40,000, actual 39,200, variance comes to 800 favorable. Standard cost of the products are as follows. Direct material 1 kg at the rate of rupee 1 per kg comes to 1. Direct wages 1 hour at the rate of 1 rupee 50 paise comes to 1 rupee 50 paise with respect to produce one product. Okay. Variable overhead 1 hour at the rate of 50 paise comes to 50 paise. Actual result for the month shown that 78,400 kgs of material were used and 70,400 labor hours was recorded. We have to prepare flexible budget for the month and compare with the actual results. And also we have to calculate material, labor, variable overhead, fixed overhead and sales variance. Can we go through the question, please? Shall we go through the question? Yes. Shall we start, my dears? Hope you understood the question. Speciality of this question is a combination of budgetary control with standard costing variance analysis. Okay. They ask you to prepare flexible budget. Yes. So the first requirement is flexible budget. Statement of flexible budget and its comparison with the actual and its comparison with the actual. Prepare 5-column table. Particulars, master budget, flexible budget, actual, and variance. 5-column table. Yes. Under the particulars, under the master budget, 80,000 units, sales quantity 80,000 units. Whereas standard is for actual 70,000 quantity. Actual is also 70,000. Sales, master budget 3,20,000. Actual column 2,80,000, which is given. Both the information actual and the master given that we can fill first. Next line item, direct material, master budget 80,000. Actual given in this question 73,600. Direct wages, master budget 1,20,000. Actual 104,800. Hope you are writing. Variable overhead 40,000, 37,600 for master and actual. Fixed overhead 40,000, 39,200. Okay, good. With respect to flexible budget, we have to rework with the actual. The expectation, we have to rework with the actual. So, what about the per unit rate for sales? The expected sales. 3,20,000 is the sales quantity, sales value for 80,000 unit. So per unit selling price comes to 4. Flexible always with respect to what? Actual, nothing but standard only. So 4 rupees selling price per unit. 70,000 quantity household. Therefore, what could be the expected sales value? 70,000 into 4 is equal to 2,88,000. Direct material, similarly, 1 rupee into 70,000. Am I right? 72,000, yes. 1 rupee into 72,000. Yeah, actually is for 72,000. Thank you. Similarly, direct wages per unit 1 rupee 1.5 into 72,000. 1,08,000. Then variable overhead 0.5 into 72,000. Comes to 36,000. Yes. Fixed overhead save 40,000 because it remained constant. Fixed cost remain constant. Kindly check it up. Flexible budget. Sales 2,88,000. Material 72,000. Direct labor 108,000. Variable overhead 36,000. Fixed overhead 40,000. Okay. Now we can go for the variance analysis. The difference you have to write, that is called variance. The last column, difference is nothing but variance. The expected sales 2,88,000, whereas actual sales 2,80,000. Difference comes to 8,000 adverse. When compared to expected sales, actual sales got reduced. Therefore, 8,000 adverse. The expected material cost 72,000. Actual material cost 73,600. Cost increase, therefore, it's favor adverse. Okay, it's adverse. Expenses increase means adverse. Income reduced means adverse. Similarly, expenses reduced means favorable. Income increased means favorable. Direct wages. Expected wages 108,000. 1,08,000. Whereas actual 1,04,800. Difference 3,200 favorable. Variable overhead. Expected 36,000. Actual 37,600. Difference 1,600 adverse. Then fixed overhead, expected 40,000, actual 39,200, therefore 800 favorable. Got it, Kana? Variance is also over. Am I right or not? In a difficulty. Next, we have to go with variance analysis. With respect to variance analysis, same chart you can use. Material cost variance can be classified into two types. Material price and material usage variance. Usage variance subclassification not applicable because there is no more than one cadre of material. So, material cost variance, price and usage variance only. Okay. One minus two, one minus three, three minus two. One represents standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. So standard quantity into standard price, actual quantity into actual price, actual quantity into standard price. Actual quantity into standard price, which is available in this question, nothing but actual material cost incurred 73,600. Whereas expectation 72,000, difference 1,600 adverse. We do the filling the blanks. Yes, material cost variance, how much? 1,600 adverse. Price variance, 4,800 favorable. Okay. Usage variance, 6,400 adverse. Good. Similarly, with respect to labor, labor cost variance can be classified into labor rate and labor efficiency variance. There is no subclassification because there is no more than one cadre of labor. 1 minus 2, 1 minus 3, 3 minus 2. 1, 2, 3 represents standard hours into standard rate, actual hours into actual rate, and actual hours into standard rate. Okay. So if you do the filling the blanks, labor cost variance, because actual labor cost available in this question, labor cost variance is equal to 3,200 favorable. Labor cost variance 3,200 favorable. Labor rate variance, comparison between standard price to actual price, 800 favorable. Labor efficiency variance, labor efficiency variance 2400 favorable. 2400 favorable. Then we check it up. Standard rate 1 rupee 50 paise. Standard hours and actual hours. 72,000 is a standard hours. Actual hours 70,400 agana. So 2,400 favorable. Similarly, fixed overhead cost variant 1,600 adverse. Variable overhead cost variant 1,600 adverse. You know the same formula: standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. Fixed overhead, budgeted and actual fixed overhead difference 40,000 and 39,200 is equal to 800 favorable. Boba. Next. Hope you understood variance with the standard with the budget. All right. We'll go to next question. I'll post the question in the chat box. Comparison with the actual dates. Comparison with Hope you are getting the question. This is what the total data available in this question. Kindly go through it. So, shall I read the question? The following is a sales budget for the first 6 months for the year 2009 with respect to PQR Limited. Month Jan, Feb, March, April, May, June. Sales quantity 10,000, 12,000, 14,000, 15,000, again 15,000, and the June month 16,000 is the sales quantity. Finished goods inventory at the end of the month is expected to be 20% of budgeted sales quantity for the following months. Finished goods inventory was 2,700 units on January 1st, 2009. Then there is no opening WAP at the end of any month. Each unit of the finished product requires two types of material as detailed given below. Material X 4,000 kg, 4 kgs at the rate of 10 rupees per kg. Material Y 6 kgs at the rate of 15 rupees per kg. Material on 1st January 2009 was 19,000 kgs of material X and 29,000 kgs of material Y. Monthly closing material is budgeted to be equal to half of the requirement of the next month production. Budgeted labor hours per unit of finished goods is 3/4 hours. Budgeted labor cost for the first quarter for the year 2009 is 10,89,000 rupees. Actual data for the quarter 1 ended on 31st March 2009 is as follows. Actual production quantity 40,000 units. Direct material cost, purchase cost of material actually used to production comes to material X 1,65,000 kgs at the rate of 10 rupees 20 paise. Material Y 2,38,000 kgs of rupees 15 rupees 10 paise per kg. Actual direct labor hours worked 32,000 hours. Actual direct labor cost comes to 13,12,000 rupees. You are required to prepare monthly production quantity for the first quarter. Raw material consumption quantity budget for January to September, January to April. Material purchase quantity budget for the quarter 1. In addition to that, they ask you to compute material cost variance, material price variance, material usage variance, direct labor cost variance, labor rate variance, and labor efficiency variance. So this question also beautiful question combined with budget and standard. Kindly go through the question quickly. Shall I start? Okay. For the first requirement now, production budget. If you remember the format for the production budget, that is sufficient. What plus what minus what is equal to production? Sales plus closing stock minus opening stock is equal to production. Sales plus closing stock minus opening stock. Sales how much available? January month 10,000, February month 12,000, March month 14,000. Opening stock given in this question, how much? 2,700. Closing stock is 20% on next month's sales. Comes to how much? February month sales 12,000. Out of is 20% is equal to 2,400 is for the January month closing stock. Similarly, 20% on 14,000 is equal to 2,800 is the closing stock for February month. 20% on 15,000 is equal to 3,000 is for March. So I will repeat. Closing stock comes to 2,400, 2,800 and 3,000 for Jan, Feb and March. Closing stock of the previous month going to become opening stock for the next month. Am I right? Therefore, 2,400 is the January month closing stock become opening stock for the February month. Similarly, February month closing stock 2,800 become March month opening stock 2,800. So, sales plus closing stock minus opening stock is equal to what? Production. What about the production? 10,000 minus 2,400 minus 2,800 is equal to 9,700. Similarly, 12,000 plus 2,800 minus 2,400 is equal to 12,400 is the production for the February month. March month 14,000 plus 3,000 minus 2,800 is equal to 14,200. Got it? So total production for the first quarter they asked 9,700 plus 12,400 plus 14,200 is equal to 36,300 is a total production for the first quarter. Understood? Now, what are the next one? Raw material consumption budget. Shall I go for raw material consumption? Consumption is purely based on production. They ask raw material consumption budget for Jan month, February month, March and April. So production is a starting point. Therefore, we need to compute production for the April month also. With respect to April month, working note, production, sales plus closing stock minus opening stock is equal to production. Sales 15,000 given in this question. Closing stock 20% on sale of the next month comes to 15,000 into 20% is equal to 3,000. Less opening stock. Closing stock of the previous month going to become opening stock for the next month. So same 3,000. Therefore, production for the April month comes to 15,000. Based on production only, raw material consumption you can be the portion to identify. So production for Jan month 9,700, February month 12,400, March month 14,200, and April month 15,000. With respect to raw material, to produce one product, you need 4 kgs of raw material X. Therefore, 4 into production, 4 into 9,700, 4 into 12,400, 4 into 14,200, and 4 into 15,000 is equal to production for the respective months. With respect to raw material raw material consumption for the respective month. So raw material consumption for X raw material consumption for Jan month comes to 38,800, 49,600, 56,800, and 60,000. This is with respect to raw material X consumption. Similarly, raw material Y, to produce one product with respect to raw material Y, 6 kgs unit. That is also given in this question. 6 into production quantity is equal to raw material consumption. Production quantity 9,700, 12,400, 14,200 and 15,000 multiplied with 6 is equal to raw material consumption for the respective months. So with respect to raw material Y, consumption comes to 58,200 for January month, 74,400 for February month, 85,200 for March month, and April 90,000. Got it? Okay. So raw material consumption over. So total raw material consumption of X for Jan to April comes to 205,200 kgs. For Y, 307,800 kgs. Got it? Next, raw material purchase budget also they ask. With respect to raw material purchase, raw material consumption, add closing stock of raw material less opening stock of raw material is equal to raw material purchase. Yes. Raw material consumption, how much we got it? For the first quarter they asked. Alright? This is with respect to quarter 1. So first quarter comes to 38,800 plus 49,600 plus 56,800 is equal to 1,45,200. With respect to raw material Y, 2,17,800. So raw material consumption. Add closing stock of raw material less opening stock of raw material is equal to raw material purchase. So closing stock 30,000 and 45,000 for raw material X and Y. Opening stock 19,000 and 29,000 for raw material X and Y. So material to be purchased comes to 1,56,200 and 2,33,800. The raw material purchase with respect to quarter 1. Right? Are you comfortable? Good. So budget over. Am I right? Similarly, you have to compute variance analysis also they ask. What are all the variant? Material and labor is there. They ask material cost variance, price variance, usage variance, labor cost variance, rate variance, and the efficiency variance you have to compute. So material cost variance can be classified into price and usage. 1 minus 2, 1 minus 3, 3 minus 2. Yes. Standard quantity into standard price, actual quantity into actual price, actual quantity into standard price. For raw material X and raw material Y. Two raw materials are there, raw material X and raw material Y are to prepare. Now, actual quantity into actual price, which is given in this question, raw material X, 16,83,000, 59,93,000 for Y. How come 1,65,000 into 10 rupee 20 paise per kg, which is given in this question. For Y, 2,38,000 kgs into 15.10 is equal to actual material consumption. Total actual material consumption comes to 52,76,800. Whereas third column, actual quantity into standard price. Actual quantity we can copy from the previous ones, 1,65,000 kgs and 2,38,000 kgs into standard price 10 rupees and 15 rupees. 10 and 15 available in this question. Therefore, standard quantity, actual quantity into standard price comes to 52,20,000. And last one, actual quantity into, that is one, and we have to compute standard quantity into standard price. The word standard always ends with actual production. How much the actual production? X 40,000 K. Actual production comes to 40,000 units available in this question. To produce one product, you need 4 kgs of raw material X and 6 kgs of raw material Y. Therefore, standard quantity of X 40,000 into 4. Standard quantity of Y 40,000 into 6. Multiply with the standard price 10 rupees and 15 rupees for X and Y. Therefore, total for the standard quantity into standard price comes to 52 lakhs. So, standard quantity into standard price is equal to 52 lakhs. Actual quantity into actual price is equal to 52 lakhs 76,800. Actual quantity into standard price comes to 52 lakhs 20,000. Therefore, material cost variance is equal to 76,800 adverse. Price variance is equal to 56,800 adverse. And usage variance is equal to 20,000 adverse. Got it? Similarly, labor cost variance can be clustered into labor rate and labor efficiency variance. One minus two, 1 minus 3, and 3 minus 2. 1, 2, 3 represent standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. Actual column information will be there in this question itself. Actual direct labor hours worked to 32,000 hours, whereas actual cost incurred comes to 13,12,000. So answer for the second column 13,12,000. Actual hours 32,000 into 41. Therefore, 41 is the actual rate. Actual hours available 32,000. Last column multiply with the standard rate. We have to identify standard rate per hour. Formula for standard rate per hour is budgeted fixed overhead, budgeted labor cost by budgeted number of hours worked. Budgeted labor cost is 10,89,000. Budgeted number of hours to produce one product you need 3 by 4 hours. Whereas budgeted production comes to 36,300. Therefore, rate per hour comes to numerator labor cost, denominator number of hours comes to 40 rupees per hour. So actual hours into standard rate, 32,000 into 40 comes to 12,80,000. Whereas standard hours into standard rate, 30,000 into 40 comes to 12 lakhs. So variable overhead cost variance, 1,12,000 adverse. Rate variance, 32,000 adverse. Efficiency variance, 80,000 adverse. Got it? So with this budgetary control and standard costing, hope you got the grip over budgetary control and standard costing. Yes. Shall I go to next area? Hope you enjoyed standard costing and budgetary control. Okay. We'll have a small break. Thereafter, we can start with the new area. Okay. Relax and come. Shall we restart? Shall we start for now? Yeah. Enjoyed the break. Relaxed. Shall we start? Yes. Now we can go for material costing. Shall we? I'll post the question now. Good. Question posted in the chat box. I'll read the question. Sterom Enterprises manufactured a single product Z. The following particulars were collected from for the year 2006. Monthly demand of Z 1000 units. Cost of placing an order 100. Annual carrying cost per unit rupees 15. Normal usage 50 units per week. Minimum usage 25 units per week. Maximum usage 75 units per week. Reorder period 4 to 6 weeks. Based on the above information, you have to compute reorder quantity, reorder level, minimum level, maximum level, and average level. Can we go through the question quickly? Questions புரியுதா பாருங்க. Yes. Shall we start? Reorder quantity is the first requirement. What we are going to reorder? We are going to reorder the quantity which is required. That is called economic ordering quantity, EOQ. Okay. Gokula Krishna, able to follow? So here EOQ is equal to reorder, economic ordering quantity. What do you mean by EOQ? Size of the order for which both ordering cost and carrying cost are minimum. Size of the order for which ordering cost and carrying cost are minimum is called economic ordering quantity. I am going to order in which size both ordering cost and carrying cost are equal, that called economic ordering quantity. Therefore, in EOQ, our object minimization of cost. Minimization of what plus what cost? Minimization of purchase price. Yes, minimization of total cost associated, total associated cost rather. Okay. Now, formula for EOQ. EOQ is equal to square root of 2AO divided by C. A for annual for demand of the raw material. O represent ordering cost per order. C represent carrying cost per unit per annum. So we have to do the filling the blanks. Clear? Find EOQ for the most commonly mistake in this area happen. Can you please find out EOQ? Apply the formula to find EOQ. EOQ is equal to square root of 2AO divided by C. Fine. Little fast, try. So what is the answer? Kindly post your answer to verify. Try now. Because the commonly committed mistake happen in this area. The answer is nobody is posting the answer. Try. 2 after all 2 into A into O divided by C. We'll see who is going to tell the first answer. Wonderful response. So 2 into annual requirement. With respect to annual requirement, monthly 1000, therefore per annum is equal to 1000 into 12 is equal to 12,000. This is what the commonly committed mistake. Most of the students commit the mistake. Clear? 1000 into 12 is the wrong answer. 1000 represent what? That is the finished goods. So production comes to 1000 per month, but A represent annual requirement of raw material demand, not finished goods demand. Understood? Therefore, you should not take finished goods, you have to take the raw material. So it's the most dangerous area, should be careful. Therefore, here A represent annual requirement of raw material. Weekly demand is given in this question. How much? 52. Whereas 52 weekly demand is what? 50 units. Yes, 50 units. Am I right? How many weeks are there? Any info with respect to this? So we have to compute normal usage per week 50. So 50 into number of weeks in a year. 50 into 52 weeks in a year. Comes to how much now? 2,600 units. Yes. Instead of 1000 into 12, you have to take what? Raw material you have to take 52 weeks into 50 is the raw material requirement per week. Is the annual requirement. Okay. Then ordering cost per order 100 rupees given. Carrying cost per unit per annum 15 rupees also given. So EOQ is equal to how much? Will you try EOQ is equal to how much? Point EOQ. Comes to 186 units. All of you got 186. Good. Shall I go to the next one? Reorder quantity over. The next requirement, reorder level, minimum level, maximum level, average level. There is also setting of various stock level based one. Formula for reorder level is equal to maximum usage into maximum lead time. Minimum level is equal to reorder level minus average usage into average lead time. Maximum level is equal to reorder level plus reorder quantity minus minimum usage into minimum lead time. Average level is equal to minimum level plus maximum level divided by 2. So, minimum usage into minimum lead time is equal to reorder level. Minimum usage 75 units. Minimum lead time 6 weeks. So 75 into 6 is equal to 450 is the answer. Kindly verify. Next, minimum level, reorder level minus average usage into average lead time. Reorder level 450 minus 50 units into 5 weeks. Clear? Comes to 200 units. Next. What is the answer? 200 got it. So 450 minus 50 units into 5 weeks. Next, note it down. Maximum level, reorder level plus reorder quantity minus minimum usage into minimum lead time. Reorder level 450 units plus reordering quantity 186 units into minimum usage into minimum lead time 25 units into 4 weeks. Comes to 536 units. Got it? Next. Average level is equal to minimum level plus maximum level divided by 2. Or, yes, minimum level, how much we got it? 200 units. Whereas maximum level 536. divided by 2 comes to 368. Okay. So I'll repeat. Kindly check it up. Economic ordering quantity answer 186 units. Reorder level 450 units. Minimum level 200 units. Maximum level 536 units. Average level 368 units. Got it? Got the clarity? Good. 50 units. Yes, 50 units. Shall we go to the next problem? Yes. Of course, next question. Can you see the question in chat box? Go through the question quickly. Now, speciality of this question. I'll read the question. EXE Limited has received an offer of quantity discount on its order of material as under price per ton and number of tons order. If it is number of ton is less than 500, price per ton comes to 1200. 500 to 1000 tons means rupees 1180. 1000 to 200 ton means 1160. 2000 to 3000 ton means 1140. Above 3000 means 1120. The annual requirement of material is 5,000 tons. The ordering cost per order is 1200 tons, 1200 rupees. And the stock holding cost is estimated at 20% on material cost per annum. Price per ton is 1500. You are required to compute most economical purchase level. Second, what will be your solution to the above illustration if there is no quantity, if there is no discount offer? Okay, can you go through the question quickly? Start பண்ணலாமா? Hope you understood the question. Depending upon the quantity order, the price also changed. Quantity discount they are giving. Accordingly, you have to compute which order size is preferable. With respect to EOQ, you know the formula for EOQ, square root of 2AO divided by C. With respect to EOQ, there are two approaches or two methods are there. One is called formula based method, another one is called tabular method. In examination, they won't specify in which circumstance you have to use the formula based method and which circumstance you have to use the tabular method. Depending upon the availability of the information, you have to identify whether formula based method is applicable or tabular method is applicable. So in this question, whenever comparison is there, whenever discounts are available, then we have to solve the problem by way of tabular method instead of formula based method. Okay. Now, this question is purely based on formula tabular based method because comparison is there. Shall we? Good. What about the table? If you remember the table format, that is sufficient to score the mark. After you do the filling the blanks. Okay. With respect to table, if you see, annual requirement is a first column. In first line item, we can put annual requirement of raw material. How much annual requirement? 5,000 tons. Then we have to prepare tabular format. First column number of order, second column order size, third ordering cost, carrying cost, associated cost, purchase price and total cost. Totally how many columns you need? 7 columns. I'll repeat. Number of order, order size, ordering cost, carrying cost, ordering plus carrying is called associated cost, purchase value, total is equal to total cost. Okay. Now, number of orders. In this question, order size available. Based on that we can take. We have to cover all the policy. Less than 500, 500 to 1000 ton, 1000 to 2000 ton, 2000 to 3000 ton, 3000 and above. Therefore, 5 probabilities are there. Therefore, 5 probability based we have to solve the problem. So less than 500, any size you can take, 499, 480, 100, 200, 300, anything less than 500 is okay. Based on our trial, what is the right answer? Where is cheaper? That only have to identify. So in this, I am going to take 100. Second trial, 500 because 500 to 1000. Third trial, 1000 to 2000. Therefore, 1000. Next, 2000 and the last 3000. So I will repeat. Trial is a order size 100, 500, 1000, 2000 and 3000. Therefore, we can identify number of order. In first line item, you wrote annual requirement of raw material 5,000 tons. If I am going to order 100 tons per time, okay, order size is 100. Then number of order should be how much? You have to divide, right? 50. Understood? Are able to follow or not? Annual requirement divided by so 50 will come, right? Similarly, annual requirement 5,000. Order size 50 means 10 orders. Thereafter 5 orders, 3 orders, 2 orders. Ordering cost per order 1200, which is given in this question. 1200 into number of orders. 1200 into 50 orders is equal to 60,000. 1200 into 10 orders is equal to 12,000. Similarly, 6,000, 3,600 and 2,400. Next, carrying cost. Formula for the carrying cost is half of the order size into carrying cost per unit per annum. So, how much the carrying cost per unit per annum? 20% on material cost, purchase price of the material 1500, out of is 20%. So is equal to 300. So half of the order size into 300 is equal to how much? 100 into 1 by 2 into 300 is equal to 15,000. Similarly, 75,000, 1,50,000, 3 lakhs, and 4,50,000. Got it? I'll repeat. Formula for carrying cost is half of the order size into carrying cost per unit per annum. Next. Ordering cost plus carrying cost is called one associated cost. Ordering plus carrying cost is equal to associated cost. Associated cost comes to 75,000. 60,000 plus 15,000 is equal to 75,000. 12,000 plus 75,000 is equal to 87,000. Lakh and 56,000. 3,06,600 and 4,52,400 is the associated cost. Okay. Then purchase value. What about the purchase value? Depending upon the tons, the purchase value going to vary. Right? In first case, 1,200 is the purchase price. Comes to 60 lakhs. In second case, 1,180, 59 lakhs. Thereafter 58 lakhs, 57 lakhs, and 56 lakhs. So total cost is equal to purchase value plus associated cost. 60 lakh 75,000, 59 lakh 87,000, 59 lakh 56,000, 60 lakhs 3,600, and 60 lakhs 52,400. So where it is cheaper? 59 lakh 56,000 is cheaper. Therefore, 1,000 quantity is preferable. 5-time purchase is preferable. Understand? One more requirement is also there. Many of them skipped the requirement. Kindly go through. What? Yes, EOQ they ask. EOQ is equal to square root of 2AO divided by C. 2 into annual requirement 5,000 quantity into 1,200 divided by 20% on 1,500 is a carrying cost. Got it? Comes to 200 tons. Yes. 200 tons is the economic ordering quantity. So first information, based on the above trial, which one is cheaper? Okay. Whereas second requirement, what is the real EOQ? Okay. Got it, Kanna? Good. So today we have discussed first one, standard costing. Second one, budgetary control and economic ordering quantity and setting of various stock levels also. With respect to standard costing, various variants you supposed to know. What all the variants are there? No. Material cost variance can be classified into price and usage. Usage again classified into mix and yield. Mix and yield applicable only if there is a quantities, there is more than one raw material available. 1 minus 2, 1 minus 3, 3 minus 2. If you remember the chart, that is sufficient. Okay. Standard quantity into standard price, actual quantity into actual price, actual quantity into standard price. Similarly for labor, labor cost variance can be classified into labor rate variance and labor efficiency variance. 1 minus 2, 1 minus 3, 1 minus or 3 minus 2, 1, 2, 3 represent standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. Variable overhead cost variance can be classified into expenditure variance and efficiency variance. 1 minus 2, 1 minus 3, 3 minus 2, 1, 2, 3 represent again standard hours into standard rate, actual hours into actual rate, actual hours into standard rate. Then fixed overhead cost variance can be classified into expenditure and volume. Volume again classified into capacity and efficiency. 1 minus 2, 1 minus 3, 1 minus 4, 4 minus 3, 3 minus 2. 1, 2, 3, 4 represents actual output into standard rate, actual fixed overhead, budgeted fixed overhead, actual loss into standard rate. Thereafter, production budget, sales plus closing stock minus opening stock is equal to production. Raw material consumption budget we have come across. Then setting of various stock level and economic ordering. It's purely formula based one. Hope you enjoyed this session. Tomorrow we can meet again. Okay. Thank you so much. Bye bye. Thank you, SICASA.